Hello, welcome to this week's podcast. Brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker, providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Good morning, Michael. And how are you feeling this morning, mate? Because you were out and about yesterday, weren't you?
Yes, I was. Very good morning to you, mate. And a happy Friday. We are recording on a Friday morning because I was out for what we could term a proper lunch yesterday. So
Out on the
I,
lash.
well, that's one way of putting it. I have felt fresher when my 4 a.m. alarm went this morning. Let's put it that way and leave it there.
I can honestly say, mate, even when I was at CMC, I very rarely set my alarm for 4 a.m. The only time I did was when I was actually having to do the BBC
Oh,
at
just drop that in.
5:30. Otherwise, it's usually about a 5:15, 5:30 alarm call.
Yeah.
So
Well,
that's
either way,
dedication.
I
That's
am.
dedication, mate.
And I'm here, and we're going to get through the podcast and hopefully provide some value. And then I'm going to go for a long lie down afterwards.
Well, that's fair enough. Well, in that case, I will jump straight to the risk warning, and then we can get
Indeed.
into the topics of the week. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so topics. We'll look at what's driving markets this week. And to be fair, I think we're pretty much drifting into year end. We're going to be
Yeah.
looking ahead to next week's Fed meeting. And I think that's what markets are sort of hanging their hats on, not only in terms of a Fed rate cut, but obviously we've got the Bank of England and the ECB the week after that.
Mhm.
Bit of M&A dominating proceedings at the moment. We've got Netflix is in talks with Warner Brothers, so we'll talk about that. Unilever looking to finalise the spin-off of its Magnum Ice Cream company over the weekend with a view to starting trading in Amsterdam on Monday.
Yes.
Looking at UK markets, the mixed PMI numbers that we've seen this week, I think reflective of the uncertainty in the lead up to Rachel Reeves' budget. We've also got
I wasn't quite as subtle as you were hoping, I don't
no, it
think.
wasn't. Have a quick look at Mitchell and Butler's full year numbers, which came out last Friday. They deferred them by a day, and we found out they deferred them by a day simply on the basis of they wanted to see what was in the budget. Um,
Yes.
Balfour Beatty's third quarter numbers, another decent set of quarterly numbers. Fraser's group, first half numbers, bit of a mixed result to them, or a mixed reaction to them. And then we'll look ahead to next week, the Fed rate meeting, UK GDP, and not much in the way of earnings to speak of really. Maybe Broadcom, that's of note if it feeds into the
Yep.
AI story. But otherwise, we've only got British American Tobacco and Kemring's full year numbers. Okay, so Michael, drifting into year end.
Yeah, absolutely. I think that's a really good way to frame it. I mean, we spoke in mid-November and we were talking about how sort of Thanksgiving will probably mark the end of the year for a lot of market participants. And I think that very much has proved to be the case. Not only if you look at how markets have traded this week, which has been in very lackluster fashion, if we're being completely honest, but also just speaking to market participants. I think there's very much a view that actually we've got, well, as we stand here now, effectively 10 proper trading sessions to go before everyone really does shut down for Christmas. You're certainly not going to make your year in those 10 sessions, but you very well could lose your year. So I think a lot of people are taking on a bit more of a defensive tone and frankly, just sitting back and watching the days go by at this point.
And the S&P is drifting up back towards the highs that we saw end of October, beginning of November. There doesn't appear
Yeah.
to be anything that is likely to derail any of the gains that we've seen thus far this year. Essentially, I think I'm looking at the markets at the moment, and I think they're just drifting higher. There's
Yeah,
no real catalyst.
No, there is no real catalyst, and I think we're still in the equity space, not just on Wall Street, but globally. We're in a market where the path of least resistance does lead higher, and unless and until a catalyst comes along to derail us from that path, which hasn't happened yet, then I think the market is just going to continue on that sort of upwards drift, probably into year end, and you'd expect that in the start of 2026 as well.
The dollar looks pretty weak, though. It's continued
Yeah,
to
it rolled
weaken.
over quite a lot this week.
Yeah. I mean, it's not had a great year anyway. But looking at where euro dollar is, looking at where cable is, even euro sterling, we've had a bit of sterling weakness, but certainly not being reflective in the pound's performance.
Yeah, and actually, cable trading just shy of 134 yesterday and today, that is very much a dollar-led move. And, the greenback has been trying to recover some of that lost ground. We're down about 10% on the year if you look at the dollar index. And we have been working to try and recover some of that lost ground. And it seems over the last week or so that rebound has just run out of steam. And some people are saying that it's participants reacting to the increasing likelihood that Kevin Hassett becomes the next Fed chair. I think that's a little bit wide of the mark, to be honest. I don't think that's a reason to sell the dollar on its own. Again, it's just a sort of continuation of the momentum that we've already seen for a majority of the year so far.
I think there's a sense that obviously as we head into the twilight weeks of Powell's chairmanship, there's an expectation that somehow any new Fed chair is likely to be a bit of a poodle when it comes to obviously implementing the US government's wishes with respect to lower rates. But as we've said on a number of occasions on this podcast, the chairman is one person. He's not going to be able to sway the whole committee. And I think markets perhaps are reading too much into the appointment of a Trump positive Fed chair in the context of actual Fed policy.
Yeah, absolutely. I mean, we've actually already seen what happens when Trump appoints a puppet to the Fed and they try and push, frankly, economically illiterate policies. Because Governor Stephen Miron is doing that right now, running around saying that, neutral is below 2% and they should cut at least 50 basis points every meeting. The reason they're not doing that is because the other 11 members of the FOMC do not believe that there's a coherent or comprehensive economic argument to do that. So Kevin Hassett, even when he is named as Fed chair, is going to face exactly the same issues that Governor Miron is currently facing. The only difference, of course, will be he is the chair, and it would be very unusual for the chair to be in the minority. But you could well end up with a situation where that turns out to be the case.
What does that say about the Fed's credibility?
I think that's a problem. I think that does then become a problem. And the policy messaging becomes a big problem because you've got, Chair Hassett, as he may be, standing up at a post-meeting press conference trying to explain a decision that he hasn't voted for. And that then becomes very, very messy in terms of signalling, in terms of credibility. But, I think the market is overreacting to that right now. We are still 6 months away from whoever it is getting that Fed chair job. And it does feel a bit like people are just trying to pin a bit of a narrative on the price action. And that's an easy one to reach for, to be honest.
Putting the cart before the horse, so to speak. Well,
Absolutely.
I think that's an interesting dynamic, and I think it's something that will develop as we head into 2026, and it'll be interesting to see how markets react to that. But we've seen in the past how I think mixed messaging at a press conference can introduce an awful lot of volatility in the stock market and the bond market in general. We've seen that with Powell when he's had to, when he's deviated off message, so to speak, away from the dot plots and what have you. And it's required weeks of clarifications from various Fed speakers. That is going to be an interesting dynamic going forward if you've got that push-pull between the chair and the rest of the committee. But obviously that's for another discussion, and it does assume that obviously Hassett does get the nomination. But more importantly, whoever gets the nomination, there's still going to be that push-pull.
Yeah, absolutely. But that's very much a 2026 story, I think.
Yeah, okay. M&A, bit of a comeback today. There's a story on Bloomberg that Netflix is in talks with Warner Brothers Discovery for its studios and streaming business. Now, that is an interesting one. Looking at Netflix's share price in the pre-market, it's only down 0.7%, despite the markets assigning a $60 billion valuation to the studios and streaming business. That's an interesting one, isn't it? Antitrust.
It really is an interesting one. I was just bringing up the Netflix price. Yeah, we're down about 1% pre-market. As you say, it is going to be an interesting one. I mean, we know that Warner Brothers Discovery has sort of been up for sale for quite some time now, and Paramount were trying to get involved with it as well. I think there are going to be quite considerable competition and antitrust concerns around that deal because, it is getting to the point where are you looking at monopolies in the media space in the United States? But as we know, this is the Trump administration, so it's effectively going to be, who has curried the most favour with the Justice Department will get their own way.
I think it's an interesting one, though, because I think it speaks to the saturation in streamers and the fact that there are so many different streaming options now available. Not only do you have Netflix, obviously you've got Amazon Prime, you've got Disney Plus, you've got Paramount Plus. Even YouTube now is starting to become a streaming destination of choice when it comes to content. And ultimately, there will need to be some sort of rationalisation because ultimately there's absolutely no way that all of these streaming services are going to be generating a profit. And Netflix is by far and away the biggest. And it's absolutely amazing for me to say that. And I haven't even mentioned Apple TV. So there will need to be some sort of consolidation. And I do notice that there will be, Warner Brothers are already getting ahead of this when they say they're going to spin off the cable channels, including CNN, TBS and TNT. So unlucky you guys if you're thinking you're going to get TNT Sports through Netflix. You ain't.
That's a completely separate issue. TNT seem to be losing their rights catalogue more and more every day. We've spoken before about how saturated the streaming market is. Everyone's got 15 streaming services that they're paying a tenner a month for, or they've got them on rolling trials or whatever. And I do actually just wonder, obviously there are other aspects to the deal, but, is that the main draw for Netflix to effectively just be buying out and eliminating one of their main competitors?
Well, also, I think it'll allow them to enhance their own studios' content because they're making an awful lot more of their own content now. And obviously, if they're able to leverage the Warner Brothers studios on top of the stuff that they're already producing.
And best of both worlds for them.
Indeed. And obviously taking over HBO as well. So home box office. So it's a big deal. And it is cutthroat. You've got Apple TV at the moment. They're discounting $4.99 for 6 weeks and then $9.99 thereafter. So even Apple, which isn't generally renowned for discounting its services, is going the discounting route when it comes to Apple TV to try and get their hooks into people to deliver that content. And their content, to be fair to Apple TV, is getting better, but it's not quite tempting me yet. But it's getting to that point where it might. Yeah.
Well, there we go. Tim Cook, if you're listening, you've got a customer on his way, potentially.
But the price...
He's a hard man to please.
But, the price point is key. I think it's the price point.
And I think that's actually... Sorry, I was going to say, I think that's going to become common for all of the streaming companies. It is effectively now a battle over price, not necessarily as much a battle over content. But yeah, I think it's going to be interesting to see how that deal evolves because it is clearly not going to be an easy path from today announced to completion at some date in the future.
But certainly I think if Netflix does get Warner Brothers Discovery, it's going to get access to a whole host of new content. And that will obviously enhance its offering even further and make it pull further ahead of its peers who have much deeper pockets, Disney, Apple and Amazon. And yet they're still number one by a distance.
Yeah, so and you'd expect them to be consolidating that position now.
You would think so. Moving on, Unilever is finally getting around to spinning off Magnum Ice Cream Company, putting the finishing touches to it over the weekend. Ben and Jerry management have once again, I think, been doing their best to throw a little bit of a fly in the ointment, very polarising with some of their political stances, shall we say. But yes. I think it's a case of what might have been I think, for London. On Monday, Magnum Ice Cream Company will launch in Amsterdam, and valuation, 15 billion euros. What might have been.
Well, absolutely. I mean, that would have been one of the biggest listings in London in quite some time. And as you say, it is very much a case of what we could have had. Yes, there will be a secondary listing in London, but that's not exactly the same thing by any stretch of the imagination. But I think it's going to be interesting to see how this one goes down. What the market reception is. I think they're going to be priced at €3.50 when those shares float next week. So it's going to be very interesting to see how the market takes that and where we go from there. Because, of course, this is, from a Unilever perspective, this is actually quite a long-running effort that the firm have been doing, not only in terms of the ice cream business, but they are really trying to, and actually are, considerably slimming down their portfolio of products and brands. And that's something that's been ongoing for a while now.
Yeah, it's just a shame that, London, this would have been a great advert for London, but unfortunately London's attractions are slowly melting away.
Yeah, absolutely. And that's terrible. And I'm going to move on from, I don't even want to acknowledge how utterly appalling that was.
Sorry, mate. Couldn't resist.
Deary me.
Anyway.
Moving on. Shall we scoop up something else?
So anyway.
Who can play that game?
Oh dear. Pull it together, Michael. Pull it together.
It's not me that went off the rails.
No, I know.
That was yesterday.
Yeah, indeed. Basically markets, pretty positive heading into year end. Yields a little bit lower. What do you make of the fact that UK yields are at the bottom end of their recent ranges?
Thankfully, the Chancellor has not come out and tried to claim credit for this. I think there are two... Yet, give it time. I think there's two drivers. Just for a bit of context, the 10-year gilt trading below 4.5% this morning for the first time in a while. The 30-year trading down at 5.15% at this moment in time. I think there's two drivers. One is, as we discussed last week, very much a kind of mindset of the budget could have been worse. Yes, it clearly was not great. Yes, there are no measures in there to boost economic growth, but also Rachel Reeves did build on her fiscal headrooms, the market taking that positively, of course. The other thing is actually more of a technical one, which is that the DMO have significantly cut the amount of supply at the long end of the curve. And I would argue that is actually playing a bigger role in this move than anything else. Lower supply of long-term gilts. Naturally, all else being equal, you'd expect the price to increase and the yield to come lower as a result. I don't think it's something we should be thinking is going to continue. Political risks are still clearly very, very prevalent. Fiscal risks are prevalent as well, with those tax hikes being backloaded in 2028, 2029 and 2030. I think this is more of a relief. Well, this is the problem. This is exactly the problem. I know it's not going to happen. You know it's not going to happen. The government probably know it's not going to happen. When the gilt market wakes up to that not happening, all of this is going to reverse in very short order.
I mean, I would argue that they're setting a trap for the next government. Yeah,
because whoever comes in, those tax hikes will be penciled into the plans, and then they effectively have a black hole, just like the one Rachel Reeves claims she inherited.
I think there's another factor involved. I think in the decline in yields, and I think the factor is this. The markets are pricing in the prospect that the Bank of England will have to cut rates, perhaps more than is originally being priced, because of the weak economic outlook. I mean, let's move on to what those PMIs...
Well, the data this week.
Yeah, the data this week. I mean, that construction PMI, lowest level since COVID, 39.4.
39.4.
Yeah.
I mean,
awful.
Disastrous.
I mean, exactly
disastrous.
I mean,
there is.
Yeah,
I was going to say there is no good way to cut that data. Yes, construction is now only 5% of the UK economy, but it's still a very, very important sector of the UK economy, particularly when the government are running around going, we want to build 1.5 million houses. Well, you're not going to be doing that if your construction sector has fallen off a cliff, which is exactly what it has done. The weakest number since COVID, utterly dire. the details of the report were pretty miserable as well. Yes, pre-budget uncertainty would have played a role in this, but frankly, you really can't see any prospect of a major recovery there.
New orders and employment showed steep falls, with housing activity and civil engineering particularly weak at 35.4 and 30 respectively. Well, if the government's ambition is to embark on a building spree, there's little evidence of it here. And I think rather than fixing the foundations, they basically dynamited them.
Well, yeah, effectively, that is exactly what they've done. And that's what I mean in terms of, you look at the leading indicators, a big fall in new orders, well, that's not going to help demand in the next 3 to 6 months. A big fall in employment, well, that's not going to help the sector in the next 3 to 6 months. It's pretty miserable, to be honest with you. And actually, even the services PMI, yes, it came in at 51.3, but that's a whole point lower than where we were in October. Again, we're just looking at an economy that is stumbling along at best and stalling at worst.
Yeah, I mean, obviously, the fact that services is still expanding is a good thing. But, as you rightly said, there is pockets of weakness there that ultimately I think don't augur well for 2026. And I think that's the key here. If the government wants to look at growth and invest in growth, the budget didn't offer any clues with respect to that, which makes you question, where it's going to come from. And I think that's why we've seen the weakness in yields. And to my mind, that's not a good thing, because essentially what the market is pricing is a much more pronounced and extended slowdown in economic activity. Fiscal risks aside.
Yeah, no, I think you're absolutely right. The one interesting thing though, and this is why I'm looking up here because I've got my Bloomberg in front of me. Actually, the market hasn't really moved its estimate for what we would call the terminal rate, i.e. how low bank rate is going to get. A couple of weeks ago, market was pricing that bank rate falling to 3.35% in 12 months' time. This morning, it's 3.32. So I agree with you. I think there is an element of economic weakness at play in driving that move in gilts. But we are still looking at an economy next year that's going to have inflation running, certainly for H1 of 2026, north of 3%, probably in the high 2% towards the back half of the year. Is there actually the room for the BOE to ride to the rescue, so to speak?
Well, that's obviously a concern. I think, and certainly I think that's something that policymakers will have to wrestle with, in a couple of weeks' time.
What is concerning is, and we heard from a few Bank of England policymakers this week. We heard from Megan Green recently, one of the external members of the MPC. One of the lines she said was she sees green shoots in the labour market. I mean, what on earth? Where is she looking to find that? The PMI numbers pointed to steep declines in employment in all sectors. The ONS data has showed payroll employment falling for 11 of the last 12 months. Where are these green shoots? I mean, is she looking at a different economy to the rest of us?
Well, obviously, Bank of England have their own regional surveys, so perhaps they're telling her something different. I don't know. I mean, only she can tell us. I'd love to know where those green shoots are, though, Megan. If you're watching this, please.
If you're listening,
please
let us know.
Please enlighten us. Okay, well, let's move away from the UK economy. Mitchell and Butler's, obviously the owners of
straight back to it.
Yeah, straight back to it. All bar one and Toby Carvery. Really strong set of numbers on Friday.
Yeah.
5.8% increase in operating profit of 330 million. 4.3% increase in like-for-like sales. Total revenue, 2.7 billion, an increase of 100 million on the previous year. The share price has popped, or did pop, but since it's
had about half of that now, hasn't it?
It's just lost half of it. I think I know why, but care to comment?
Go on, fire away.
Well,
enlighten us.
Obviously, as with any budget, the fine print is sort of the key element to it. And since obviously the headlines have subsided and people have started to read through the budget, they've started to look at business rates.
Yes.
And
which
pubs
are going to kill pubs.
Yeah, absolutely kill them. And reading through that fine print, even though Mitchell and Butler's did say that they expected cost headwinds of 130 million after analysing the recent budget. Obviously, they only had 24 hours to do that. Over the weekend, more detail has come to light, and I think people have realised perhaps that 130 million is a conservative estimate.
Yeah, and I think it probably is. And for those who are unaware with what's going on with business rates, I think there's actually two issues. One is that we've had effectively relief or a holiday on a proportion of business rates. I think it's about 40% that's been in place since the pandemic, and that's coming to an end next year. The Chancellor's not rolled that on. They are also looking to revalue and re-rate the levies that businesses pay based on the premises that they're in. And as you say, funnily enough, Rachel Reeves didn't make a big thing of this at the dispatch box on Wednesday, 2 weeks ago or a week ago, because they are very, very onerous costs that are going to be levied, and of course they are going to hit businesses very, very hard indeed. And setting Mitchell Butlers aside for a moment, because obviously as a larger firm they are likely to be able to weather this a little bit better, even though it will impact the bottom line, it's the independent pubs and restaurants and cafes that are going to be absolutely battered, if not sent to the wall by this.
Yeah, I mean, I was looking at the numbers, and actually Tesco's, the big retailers, actually come out of it pretty okay. The problem is in the middle. And UK is stacked full of small and medium-sized businesses who are going to be absolutely battered by these business rates. I mean, who drew these plans up?
Well, I have no idea. What I can tell you is if anyone checks my Twitter, I'm not saying it on a podcast, but Labour MPs have come up with a nickname for the people who came up with the budget.
Oh no,
very much not a safe podcast word.
No, but I mean, I think I've made that parallel as well, like calling a certain Mr. Bell and then using another word on the end.
Something else,
yeah, exactly. Use something else at the end of his name.
Yeah, but you're right. I mean, this has been thought up by people who've clearly got no idea or experience of how the real world of business actually works. It does feel as if some sort of U-turn will have to happen on this front, because otherwise it is going to absolutely decimate the hospitality sector when it comes into play.
Well, you'd like to think so, wouldn't you? But I'm not holding my breath.
Especially when you've got minimum wage and living wage hikes in the mix as well. Yeah. How many more costs do you want to put onto these businesses?
No. I mean, so obviously since that update on Friday, Mitchell and Butlers haven't actually commented on what these business rate changes might mean for them. So it's hard to conclude they won't be adversely affected by them. And I think that's been reflected in the share price movements that we've seen this week since those Friday peaks.
Well, I think the logical assumption is they will be affected by it. And I think the assumption is almost every business will be affected by it.
Good. So let's have a good news story. Balfour Beatty, third quarter numbers.
Yes.
Share price again up for the pretty much fourth day in a row now. Nothing in those numbers that would appear to suggest that the business is going anywhere but higher. 4-year guidance on its order book, 20% increase on its order book.
Yeah, which is really, really impressive, as you say. And again, just a really strong set of numbers. They're on track to meet their guidance, meet their expectations. Profits are going to be up year on year. And it is a company that is moving in the right direction, and moving in the right direction in relatively rapid fashion, which, frankly, we don't have enough of here in the UK.
I mean, it's strange, isn't it, Michael? You've got a UK construction sector that's flat on its back.
And Balfour Beatty is smashing it. Yeah,
smashing it out of the park. But obviously they get an awful lot of government contracts. So obviously HS2, all of that work that's going on around the M6 in Birmingham, which I sort of regularly drive past on my trips up to Scotland. But also the power grid upgrades that they're bidding for, the electricity grid upgrades. So obviously they're the front of the queue for that. So in the context of that, big is better, which is great. But we all know that these projects usually end up costing a hell of a lot more than they should.
Yes, exactly that. But in the meantime, anyway, it's a boon for the stock, because I'm pretty sure we're trading at record highs. We
are, and actually I was looking at the move since the April lows, and they've gone from 369p, and they're now currently at 724.
Yeah.
So...
They've basically doubled in 6 months.
Almost doubled in 6 months, indeed. And looking to do further buybacks heading into 2026.
Yeah, which is naturally going to provide further support to the price.
So a very good success story. A new CEO, Philip Hoare, appears to be taking on the reins in the same way as his predecessor, Leo Quinn. Anyway,
Yes.
Fraser's Group, first half numbers. Again, nothing really to shout about there. Those peaks at around about 775 have held for the last 3 months, drifting back towards the lower end of the range. Decent improvement in revenues. Interested to see where the growth was, though, Michael. And it wasn't in the UK.
No, it wasn't. And they were also flagging an improvement in the luxury space as well, which is certainly not going to find in the UK. But yeah, the rest of the world part of the business seems to be really starting to pick up. And I think again, this speaks to the diversification that we've joked a number of times that Fraser's Group has basically bought up half the high street. Well, actually, that's starting to pay dividends because is that diversification which is allowing them to effectively shrug off the sort of woes that are impacting the wider retail sector at this point.
Yeah, I mean, retail profits were up 12.2%, but international retail saw income there rise by 42.8%. Whereas obviously in the UK and the rest of the other businesses, it's continued to struggle. And they have pointed to the fact that the budget meant that trading remains challenging. I think the big test, and we've said this before in the lead up to Christmas, I think is, in spending between now and Christmas Eve. Because when we look at the new year, we've got all the trading updates from the likes of Sainsbury's, Tesco's, and all the other big retailers, and that should give us a flavour of what to expect heading into 2026. Next as well. I think, memory serves me correctly, next Marks and Spencer's, Sainsbury's, and Tesco's generally in the first 10 days of January give their Christmas trading update, so they'll be very interesting.
Yeah, absolutely. And it is that pivotal time of the year for the retail sector, that run up to Christmas. And it will be interesting to see what spending looks like, particularly because obviously, the sentiment among consumers has fallen off a cliff in the run up to, the budget, but also run up to Christmas, given the timings. So yeah, it'd be interesting to see whether people do tighten their belts a little bit on that front.
Anyway, with pretty much 2 weeks to go, obviously we're moving on to next week now. Unless there's anything.
One last thing,
actually.
Go on. Yeah, I was just going to mention something I wouldn't usually mention on the podcast. We had the quarterly rebalancing for FTSE 100 this week.
Oh, right.
British Land are coming back, and they are replacing WPP, who have been in the FTSE since 1998. Very good year, that, of course. But it's almost a sort of changing of the guard moment, I think, that one. Shows how significantly the advertising space has declined and also how terribly WPP have fared in recent years.
Well, I think the problem with WPP, and we've talked about this before, is they haven't adapted to the changing advertising environment where basically Google search has overtaken
and Meta rule the roost,
and essentially taken over the advertising space using various methods, online methods. I mean, I'm looking at WPP share price, and it's at multi-year lows, showing little.
I was going to say, one look at that chart will tell you everything you need to know about why they're coming out of the index.
Yeah, pretty much. I mean, the move below 450 early this year, I think, was a death knell, and it's going to be very, very difficult to recover from that. The CEO has got a real mountain to climb when it comes to, I think, turning that business around. But perhaps a spell out of the limelight will be the tonic that it needs, because I think historically, companies that have fallen out of the FTSE 100 generally have tended to perform better once the initial shock has worn off. I can give you Royal Mail for an example. When they dropped when they dropped out of the FTSE 100. A while ago. They're not back in it now, are they? I can't remember. But
I don't think so, no.
They then quickly bounced back to go back into it. And I can name any number of companies who've dropped out of the FTSE 100, spent some time in the FTSE 250 and come back. Yeah.
So maybe it might not be the worst move, but we'll obviously keep an eye on that one. Anyway, next week.
Fed. Okay, I've written a note on my Substack about my expectations for the Fed. The expectation is we'll get a rate cut, 25 basis points. It'll be very surprising if we don't get one. And I don't think the Fed will want to surprise the markets just before Christmas. So I think it's quite likely we will get one. The big question for me is whether there will continue to be a three-way split on the committee. I don't think there will. ADP this week was weak. Jobless claims, though, was fairly low. So care to cast some light on this week's US data? And obviously we've got PCE today.
Yes, we do, although the PCE data is for September, so at this point it's not exactly worth the paper it's written on. The data was interesting. I mean, the jobless claims stats yesterday, obviously lowest initial claims number since September of 2022. I would caution, though, that it was referencing Thanksgiving week. So we do need to, I think, take that with a little bit of caution because there could be some seasonal skew in the numbers. The PMIs that we've had this week have been okay. The services, ISM services metric was at a 9-month high, but I disagree with you. I think we will still have a split on the FOMC. I think
a three-way split.
So a three-way split depends on how many people vote for unchanged.
Right.
Now, let me elaborate on what I mean with that one. So obviously back in October, Kansas City Fed President Jeffrey Schmid dissented in favour of keeping rates steady. I think he'll probably be joined this time around by St. Louis Fed President Alberto Museum and probably Boston Fed President Susan Collins as well. Now, where it gets a little bit difficult in terms of going, is there going to be a three-way split? And what we mean by that, of course, is basically, will Governor Myron dissent for a 50 basis point cut? I think he's been very clear, actually, for once, in his pre-meeting remarks, which are basically along the lines of, I want rates to be much, much lower than where they are now. We all know that. I would vote for a 50 basis point cut, is effectively the baseline for Stephen Myron. However, if his vote is the marginal vote, if it is his vote that determines whether rates are cut or held steady, then I think he'll vote for a 25 basis point cut, essentially going, I want rates to be lower. This is the only magnitude of a rate cut that I can achieve at this point, similar to what Alan Taylor at the BOE did back in August. So I think fundamentally there will be a 25 basis point cut. As you said, markets price it as a 90% chance. The Fed won't disappoint on that because you'd have such an unwarranted tightening of financial conditions in reaction. It would be a complete mess. The question is, what do they say about next year? Because you've clearly got a very, very divided committee now. You're getting the Fed funds rate closer and closer to a more neutral level. Every cut is going to become harder to deliver. What does the guidance look like as we move into next year? Remembering, of course, that Powell has, after Wednesday, he's got 3 meetings to go as chair, and then he's out.
So there's a possibility we could get what I would euphemistically call a hawkish cut.
I think that's probably the base case, would be they lower rates, but they don't really give any sort of concrete guidance as to when the next cut is going to come.
Watch this space.
Indeed.
All right, UK GDP for October.
That ain't going to be pretty, is it? Let's be honest.
Well, these are monthly numbers, so regular listeners will know that I don't set a great set of stock by them. But as a general rule of thumb, they do give a decent guide as to how the economy is performing on a, sort of a rolling quarterly basis. So you look at September and you look at August. There was no growth at all in August and September. It's hard to imagine there'll be any in October, given obviously the uncertainty around the budget. So you could see. I think that could potentially rubber stamp a cut by the Bank of England.
I'd argue that a cut is probably rubber stamped already. The big risk to that view is the November inflation numbers, which we get not next week, but the week after.
Which is the same week as the decision.
Well, I think it's the day before,
yeah.
Although the MPC will have an advanced sight of the data. In terms of expectations for GDP, though, just looked at the Bloomberg consensus. Consensus points to growth of 0.1% on a month-on-month basis. Decent chunk of that you might see as actually being mechanical. Effectively, the JLR shutdown came to an end, so things might rebound a little bit. But on a rolling 3-month basis, we're expecting growth to be completely flat, and clearly risks to that outlook still tilt firmly to the downside, because this is October data, which was clouded by pre-budget uncertainty. November will have been clouded by pre-budget uncertainty as well. And then we move into December in 2026 with the reality of that significantly tighter fiscal policy. So, not much cause for optimism, I don't think, sadly.
You might get a rebound in December as people go out and spend money ahead of Christmas, perhaps, which might provide a small end-of-year boost. But I think certainly in the context of the overall wider economy, it doesn't look promising, aside from the fact that potentially we could see yields edge lower on the basis of expectations of future Bank of England rate cuts. But, that's not the positive story that you really think that it is.
No, as we discussed earlier on. And in any case, it is, of course, monthly data. So take that with a health warning, as always.
Yeah, because it gets revised constantly.
Yes, exactly.
Okay, so moving on to earnings, and there's not much on the slate really. We've got British American Tobacco, its full year numbers. Again, new generation product revenue remains a small but growing part of the business. Like Imperial Brands, it's done well this year. Shares up over 40% year to date. I don't really expect too much market reaction to it. First half revenues were down in June. As I say, they're making cost savings. Forecasts for the full year, be interesting to see what they project or what they actually finally come out with. But again, it's one of those boring companies that is a fairly decent income stock if you're a dividend investor.
I was going to say it's got 5.5% dividend yield, which is probably the main attraction of that stock. But the tobacco names have done well this year. But like you, I don't particularly see that earnings report being a massive catalyst for anything, which probably means they now move 10% on the 9th at the market open.
Yeah, I doubt it. They're not at £43 a share.
Yes, very true.
Kemring full year numbers. Now, back in November, this is a defence stock. Okay, so it was one of our tips, not one of our tips, but was one of the companies we talked about back in March, April that we thought could do well, and it has done well. It's still up on the year. It got a boost in May, June on the back of bid talk from Bain.
Yes.
None of that's materialised, and as a consequence of that, the shares have slipped back. But the overall case for the business hasn't changed. I mean, it's still seen an increase in its order book. The prospects for the company still look promising, despite the fact that there could be an imminent cessation of hostilities between Russia and Ukraine, if you believe that. I'm not convinced.
Yeah. No, I mean, obviously, we all hope that there is a ceasefire or a peace agreement there, but I agree with you. I don't think it is imminent, certainly not judging by the reporting we see. But yeah, it's an interesting one. I think the market probably got a little bit overexcitable with all of the bid and takeover talk and Bain Capital. And then when that sort of all just fizzled out, obviously, the stock came with it. But as you alluded to, the backdrop is still a very, very constructive one for the name. It's a very constructive one for the defence sector at large. Order books are ballooning in terms of both volume and value. The key question is, can these firms continue to actually keep up with demand? But even if you were to see a peace deal in Ukraine, that does not mean that all of a sudden all of these defence spending pledges are going to come to an end. In fact, I think quite the opposite. We governments across Europe recognise that more needs to be spent on defence, more will be spent on defence. So again, it looks to me as if the backdrop is still very, very favourable.
I mean, before the Bain talk, the shares were around about 400p. They went up to 600p. They've had 3 attempts at 600p. They've dropped back to just under 500p, 483p. So,
and we're still nicely up on the year.
Yeah, we are. But I think the big question is, where do we go from here? And certainly I think the fact that we've dropped from 600 below 500 perhaps suggests that some investors have lost their enthusiasm. But I can't help thinking that at some point that may well return.
Yes.
Last but not least, we've got Broadcom fourth quarter numbers.
Yes.
I mean, again, it's ridden the AI boom, this one. Shares record highs, dropped back a little bit, a bit like Nvidia in recent weeks as
Yeah.
attention has shifted to Google or Alphabet.
Yeah, and actually, I'm glad you mentioned. I know we're going to talk about Broadcom in a second, but so the Nasdaq bottomed out on the 20th of November, the local low that we printed in the Nasdaq. Since then, we're up about 8%, or at least we were. And I was looking at these numbers yesterday. Over the same time period, Nvidia is flat. It has not gone anywhere while the market has rallied, which again, everyone's been saying AI is all an Nvidia story. Well, that is, as you rightly allude to, starting to shift because obviously Google are now taking more of a market share. Gemini seems to be, setting the world alight, et cetera, et cetera. But yeah, it's going to be interesting to see what Broadcom come out with this week. I think not only for the stock in question, but also they will be seen as a barometer for the likes of Nvidia and a lot of the other semiconductor names, which will probably trade in sympathy with what Broadcom report.
I mean, Broadcom are expecting $17.4 billion in revenue for Q4. They showed $15.95 billion in revenue in Q3. AI revenue is expected to see a further acceleration to $6.2 billion for Q4. So, there is growth there, and the growth is very much in its AI semiconductor segment, which rose 63% in Q3.
Yeah, absolutely. And I think really what we said about Nvidia's earnings a few weeks back applies to what you would say about Broadcom. The market's looking for three things. It's looking for a beat on those expectations that you just outlined. It's looking for guidance to be hiked going into the next quarter or the next fiscal year in this case. And it's also looking for bullish commentary from the board that they see the AI theme continuing, that they see demand continuing to accelerate for a number of quarters to come. If you get those three things, then you would expect the stock to bounce a little bit.
Semiconductor revenue, semiconductor solutions now accounts for 57% of total revenue, with VMware and other infrastructure software accounting for the remainder. So, again, it's about expectations or beating expectations or beating forecasts, but also what's their guidance going to be for 2026.
Yes, absolutely.
So certainly scope for another pickup towards the upside, but also cognizant of the fact that people aren't going to load up too much ahead of Christmas,
11th of December.
Yeah, exactly that.
Sorry,
exactly.
I'd lost the date there.
Don't worry.
You're talking 6 days before Christmas. You're absolutely right. Conviction might be lacking a bit.
Just a bit. So that may not be reflective. Even if there are a good set of numbers, you may not get the pop that you think you get.
Yeah.
All right. Well,
I think that's it.
I think that is it. I mean, we've got GameStop, but whatever. Meme stock, GameStop.
Someone will post on Reddit about it, and it'll go somewhere.
I mean,
there you go. There's your GameStop
if you're interested in what I've said about GameStop, it's on my Substack, so you can check it out on there. Okay, well, that's pretty much it for this week. So obviously, we will talk about the Fed when we reconvene next week, and obviously we'll preview the Bank of England and the ECB. But, as we head towards sort of Christmas and the New Year, in fact, we will be doing a little bit of a preview of 2025 and what to look out for in 2026. So I can't imagine it's going to be too much different to what we've already been discussing for the past few weeks.
We'll do it as a Christmas present to our listeners anyway.
Indeed. All right, Michael. Well, I hope you enjoy the rest of the day, and We'll reconvene same time, similar time, same place next week.
Indeed. See you later.
Cheers, mate.